want to keep anybody waiting. I think, David, should I go ahead and pull up your presentation, or you want
I sent you a PDF that you can share with the folks afterwards. I'll pull it up here.
Okay, excellent.
So hopefully,
there you go.
So I can see you guys. Hopefully you guys can see the presentation with another Philadelphia picture in the background. I like to keep these presentations real informal. I'm kind of like looking at the presentation and you're over on the other screen. I like to keep these real informal. If you have questions, feel free to raise your hand or type something in the chat and Susanna can interrupt. This is for your information. I put together 16, 17 slides of stuff that I think is important, but again, feel free to interrupt so that we can get you the information that you need to have. There we go. We'll skip the disclosures. We'll skip the agenda. We'll go right into it. I like to start with the math, right? Why should we do a 1031 exchange? And this example is based on a real life client I had a few years ago in Philadelphia. I hope you guys can see the math here well enough. If not, again, Susanna has the PDF and you'll be able to view it there afterwards. But the client had initially purchased the property for $2 million and he was selling for $6.5 million. So right off the bat, this client's doing all right, right? And over the course of the 10 years that he owned the property, he took about $500,000 in depreciation. Look, this math is bigger than what some of our clients might be working on. But if you lop off a zero and call it a $200,000 purchase that he's selling for $500,000, the math is all still the same, right? It's just bigger numbers. So if this gentleman does not do a 1031 exchange, that's the set of math on the left-hand side, he's going to have to pay depreciation recapture. That's 25% of the depreciation that he took over the years. He's going to have to pay 25% of that to the federal government. He'll have to pay 3% to the Commonwealth of Pennsylvania. And then on the capital gain, 20% to the federal government, 3% to the Commonwealth of Pennsylvania. And oh, by the way, the 3.8% Medicare surtax that was part of the Obamacare program. So when he sells this property for $6.5 million, after he pays all those taxes, he ends up with $5.3 million. Now that's not counting transfer taxes and brokerage commissions. That's just the taxes as a result of the sale. If we slip over to the other side of the page, it's important to note here that in Pennsylvania, you still pay the taxes. Pennsylvania doesn't recognize Section 1031. So you'll still pay your depreciation recapture and your capital gains to Pennsylvania, but you'll defer all of the federal taxes. So the same $6.5 million sale now nets our client $6.3 million. Huge difference from 5.3 to 6.3. That's better than 20% savings. And if we're talking about properties where he's going to have a 60% loan to value, without the 1031 exchange, he can buy a $13 million property. And with a 1031 exchange, he can buy one for almost $16 million. Now, again, I recognize that this math may be bigger or smaller than some of your clients, but that's the example, okay? So after I went through this math with the client, he said, yeah, but David, this is all like really good. What does it cost me to do a 1031 exchange? The average price for a 1031 exchange, depending on the size of the transaction, the complexity of the transaction, we'll talk about some of those issues as we go through the next bunch of slides. The average cost of a 1031 exchange is between $1,000 and $2,000. So spend $2,000 to save $1 million. That sounds like a real good return on investment in my mind. So that's the basics of why to do a 1031 exchange. All right. Now, some of what we're going through, there are timing restrictions and other restrictions that we have to deal with as part of a 1031 exchange. They can be sort of the downside to doing an exchange. So let's move forward. We start with the premise that under the Internal Revenue Code, if you make $1, you have to pay tax on it unless you can show the IRS why you shouldn't pay taxes on it. And even illegally earned income is supposed to show up on your tax return. There's a line for it on your tax return. I call that the Al Capone clause, because they never actually proved that he was selling booze, but they did prove that he was making more money than he was telling the IRS. So Section 1031 says that you do not recognize the gain on the sale of real estate, real property, that was held for productive use in a trade or business if you exchange that property solely for property of like kind. Like kind is where a lot of our clients get tripped up. If I'm selling a row home in South Philly, that doesn't mean I need to buy another row home. If I'm selling a condo, that doesn't mean I need to buy another condo. If I'm selling a duplex, that doesn't mean I need to buy another duplex. The issue of like kind was really much more important before the Tax Cut and Jobs Act, because we previously were able to do 1031 exchanges on non-real estate assets. So if I was selling an investment asset, a franchise, a racehorse, a collector automobile, I needed to buy another racehorse. I needed to buy another collector automobile. Now, for real estate purposes, all real estate is like kind to all other real estate. We'll go over that in a little more detail. It is important to know, though, that the statute provides for the deferral of these taxes. Meaning, if we do a 1031 exchange on today's transaction and we do another one in 5 years and we do another one 5 years after that, and then later we sell that last property in the chain, then all of those taxes that we were deferring over the years come home to roost and we have to pay them. Okay. So 2 things to keep in mind. Theoretically, we're in our peak income years now. And if we get to a point later in life when we're retired, we would theoretically be in a lower tax bracket, which would drop down our capital gains rates at the Fed and our depreciation. Well, the depreciation is going to stay the same, but the capital gains rate could very well fall down into a lower tax bracket. So there's one thing to keep in mind. The other thing to keep in mind is that 1031 becomes a very powerful estate planning tool. Because if grandpa does a 1031 exchange and then 5 years later he does another one, and then 5 years later he does another one, and then he dies, grandpa's heirs inherit the property at the fair market value as of the date of his death. They get a step up in basis. So they don't pay the capital gains tax. They don't pay the depreciation recapture tax. Those taxes go away.
David?
Yes, ma'am.
We have a quick question
Please.
that may not be relevant to 1031, but it is to what you're talking about with heirs. It asks, what if you never sell the property? Does the basis hit the heirs during the probate filing?
So that's exactly the point.
Just answered that before. I typed the question
Okay.
and then he answered it. I was like, you're
Okay.
I was speaking too fast for Daniel's fingers.
No, more so for mine. I apologize.
That's quite all right. That's quite all right. So to reiterate, what happens is the heirs, all of those taxes go away, and the heirs get the stepped up basis, the fair market value as of the date of grandpa's death. So if grandpa dies owning a $6.5 million building, and then the heirs turn around and sell that building virtually immediately, they will have no capital gains taxes to recognize. Now, there may be estate taxes or inheritance taxes or those kinds of taxes, but there are assets to cover that, right? So if they were going to sell the assets, it's not a horrible thing. And also theoretically, grandpa had some life insurance as well.
Could I follow up real quick on that?
Sure.
So what if you put the properties in a trust? Does the trust then have the step up in basis as well? And and obviously not related to a 1031, is there inheritance for the transferring of the property into the trust?
So if I own my properties in a trust, so this is one of those things where I highly encourage clients to speak to their attorneys and their accountants before they change the ownership structure of their investments. If you put the property into a trust, the trust doesn't have a natural lifespan. It won't die. So there will be no point in time where the trust dies and the heirs get the property at the step up in basis. If the trust is one of the heirs, then the trust gets the property at the step up in basis. But the trust itself won't ever die. Okay. Now it is very common for investors. This is sort of parallel to Daniel's question. It is very common for investors to own properties in an LLC. And if grandpa owns the property in an LLC and grandpa is the sole member of that LLC, then that LLC, for all practical purposes, for taxpayer purposes anyway, dies with grandpa. So a single member LLC is a disregarded entity for federal income tax purposes, and it would be treated as grandpa for income tax purposes.
David, a couple related questions. Nicole asked, is there another mechanism we can use to avoid paying the piper at the end, like a trust? We talked a little bit, or IRA. And then a second question from Jeff was, with the 1031, do you still have to pay local taxes as well as state taxes?
So the local and state tax issue, the city of Philadelphia, the Commonwealth of Pennsylvania do not recognize Section 1031. So to the extent that they have capital gains tax mechanisms in place, you'll have to pay those taxes. The transfer taxes at the local, county, and state level also are not affected by Section 1031. So I kind of view those taxes more like sales tax, right? You go and you buy a stereo, you're paying sales tax on it. Well, this is the same thing. You sell a piece of real estate, you have to collect sales tax, and actually it ends up coming out of your share of the proceeds. As to other mechanisms to defer or avoid paying capital gains tax, owning real estate in my IRA doesn't necessarily avoid capital gains tax. One of the negatives to owning real estate in the IRA is that I cannot live off of the proceeds of the real estate. So if part of my current income stream is the rental income from my rental properties, that's wonderful. But if I put my rental properties in my IRA, then the income stream has to go back into the IRA. I can't live off of that money. So again, talk to your attorney, talk to your accountant to figure out what is best for you. If you don't need that income to live on, if you don't need those rental payments each month as part of your living expenses, then putting it in an IRA is not necessarily a bad thing, but it's not necessarily the right thing either. Again, putting it into a trust may or may not be the answer. Those questions as to whether it should be in an IRA or in a trust or any other mechanism, I always encourage my clients to talk to their attorney and their accountant, because there is no one answer that is right for everybody. In my humble opinion, Section 1031 comes dangerously close, because if you're going to make money on the sale of investment real estate, then you owe it to yourself to at least investigate a Section 1031 exchange. Of course, we'll talk about some of those other headaches that we come across as we go through some of these next slides. So I mentioned a couple of minutes ago that like kind is a very broad definition in real estate. And here's how broad it is. I mean, all of those 8 pictures on there are like kind to one another. So I can sell a ranch and buy retail. I can sell a rental house and buy an office building. I can sell commercial and buy raw land. All of that is like kind to each other. But really, the only restrictions are it can't be primary use property, meaning it's not my primary residence and it's not my shore house. And I can't exchange out of domestic US property into foreign property. So my neighbor across the street has been vacationing in Mexico. He can't sell an investment property here in the Philadelphia area to buy a rental property in Mexico, because Mexico is not part of the United States. Some people might think otherwise, but it's not. Okay, so like kind is very broad. I put it this way when I'm talking to a room full of real estate agents, forgetting about whether your state license is applicable. If a real estate license would allow you to get a commission on the transaction, it's real estate. So if I'm entitled to a real estate commission on the sale property and I'd be entitled to a real estate commission on the purchase property, then they're like kind, regardless, forgetting again, of course, of the state boundaries. Okay, here's where we start to talk about some of the headaches of a 1031 exchange. In 1984, Congress incorporated into the statute 2 time restrictions. And the time restrictions were actually born out of a very famous case called the Starker case. So if you ever hear a 1031 exchange referred to as a Starker exchange, this is sort of the outshot of that transaction. From the date of the closing on the sale property, our client has 45 days to identify a list of potential replacement properties. And we'll talk about that list momentarily. And from the date of the sale of the relinquished property, they have 180 days to complete the acquisition of something on that list. Those 2 stopwatches, the 45 days and the 180 days, run concurrently. So it's not 45 plus 180, it's up to 45 days to identify, up to 180 days to complete the acquisition. And oh, by the way, it's 180 days or the due date of your tax return. So if we start approaching October, 180 days from October 31st takes us well past April 15th. So starting early in October, we start to counsel our clients to pay attention to their acquisition deadline so they can ensure they complete that purchase before they file their tax return. It's calendar days, not business days. So if there's whatever holiday you can think of, whether it's something generic like President's Day or something religious like Christmas, Kwanzaa, Hanukkah, or Ramadan, those don't allow you any extensions on the completion of your 1031 exchange. In fact, there are no extensions on the completion of your 1031 exchange. You cannot file for an extension on your 1031 exchange. You can file for an extension on your tax return, but not on your 1031 exchange.
David, quick question, and I think you're answering it in this sense, but Daniel wanted to know if there's any extension possible in the 45 days to identify properties.
So I was literally about to say the only way to get an extension on the 45 days or the 180 days is to, I don't know, be the beneficiary or the victim of a presidentially declared disaster. Think Katrina or Sandy or 9/11. Absent events like that, you cannot get an extension on either the 45 or the 180 days. So there was just a notice from the IRS Friday that Texas and Louisiana got extensions for a host of tax-related matters because of the storms that hit down there in February. It doesn't impact us. The same storms came up and hit us, but it didn't shut down the whole Philadelphia region because 6 inches of snow is not a whole lot of a big deal here. So absent something like Sandy or Katrina, we're not getting an extension on the 45 or the 180. Okay. A good qualified intermediary will advise you of what those dates are as soon as you sell your relinquished property and work with you carefully to help you ensure that you get those identifications and purchases completed in time. Okay, so if Section 1031 were a dance, it would look a little bit like this. Our exchanger is the gray circle, the gray oval at the top of the page. And at the beginning of their exchange, they sell their relinquished property and they transfer it by deed directly to the purchaser. The cash from that transaction, instead of going back to the exchanger, the taxpayer, would come to us as the qualified intermediary. They would then have 45 days to identify, 180 days to close. And when they're ready to make the purchase, we would send the cash to the closing table and the deed would go directly to the exchanger. So many folks get confused. They think that the qualified intermediary has to get inserted into the chain of title. That's not true. We do ask to be on the closing statement, just to sort of belt and suspenders the paperwork for the 1031 exchange, but at no time does the deed need to pass through the qualified intermediary for a traditional forward 1031 exchange. We'll talk about reverse exchanges momentarily. And then across the bottom, there's that timeline again, up to 45 days to identify, up to 180 days to complete the acquisition.
Excuse me, David, before we go on, while we're talking about timeframes, we have 2 more questions. Is that all right? One, Nicole has a great question. She asked, I'm sorry, hold on one second. If you sell a property, flip it in less than a year from purchase date, are you subject to capital gains?
That's a great question.
And then in terms of time frame, there are a couple questions that came up. You know, is there a limit on the number of properties you can identify within the 45 days? And also, do they have to be on the market to go on the list?
Okay, so I'm going to address that last couple of questions coming up in the next couple of slides, so I won't answer them right this minute. As to the fix and flip issue, the intent when you acquire the property needs to be to hold it for investment purposes. So if I buy the property with the pure intention of being of flipping it out real quick, that's not a 1031 exchange. Your intent should be to hold it and use it as a rental. Now, that said, if I buy a property on March 15th and my intent is to put it on the rental market, I'll go inside and I'll, touch up some paint and maybe fix a couple of things, maybe change the faucets in the bathrooms in the kitchen to make it look a little nicer, whatever it may be. But then out of the blue, I get an offer offering substantially more than I paid for the property. That's different. My plan was to use it as a rental, but somebody came in and made me an offer that's too good to be true. That's different. So to buy a property and hold it for 6 weeks, 6 months, or even a year, purely for the intention of flipping it. Now, if you're holding it for a year, I guess your plans as a flipper didn't work out as well as you had hoped, right? But it's really a function of what was your intent at the date you acquired the property.
Hey, Dave,
How
I
do
have
you
a question
document
about that.
it? What's that?
I'm sorry, I have a question about that. How do you prove your intent? So I've had plenty of times where I purchased a property, rehabbed it, and was planning on holding it, and the market was just booming. And of course, I can get way more, than I expected in the beginning. So I go ahead and sell it. Now, my original intent was to hold it, but because of the funds that I could make from it, I decided to sell it. How do I prove that my original intent was to
Sean,
rent?
that's a phenomenal question. So here's one of the things. When we purchased the properties that we currently hold, as part of my due diligence, I did 5-year cash flow projections on those properties. And I still have in the folders for those properties the Excel spreadsheet where I did the 5-year cash flow projection. Now, it's more than 5 years ago, so my projections are kind of irrelevant at this point in time. And I think the way you would do it, and I'm going to preface this by saying I want you to double check with your CPA before you do or do not do a 1031 exchange. But I think if I were in your shoes, I would, when I look at that property, one of the first things I'm thinking about is, okay, well, let's see, I'm going to buy it for 100. I'm going to put 10,000 into it, and then I can rent it for 900 a month, 1,000 a month, whatever the numbers are, right? And I'm going to start writing that out. I might do a 5-year cash flow projection based on those numbers. But then when we get to the end of the rehab period, and I still think, I bought it for 100, I put 110 into it. Now all of a sudden somebody's offering me $150. Well, that's different, right? If that offer came out of nowhere, that's different than if you put a for sale sign in the front yard. That's different than you using your market knowledge. And we have to talk about that for a moment. That's different than you using your market knowledge to know that rehabbed properties in this neighborhood are going for X, right? Which is substantially more than you now have invested in it. You folks as investors sort of have a target painted on your back. because your primary profession is the sale of real estate. So the IRS is going to look at you with a slightly jaded view to begin with, because you're already working in the real estate industry. So if we take your real estate profession out of the conversation for a moment, and Mary goes out and buys a property for $100,000, and she puts $10,000 into cleaning it up and upgrading it a little bit, and she now thinks it's worth 111 because she just put 10 into it, and she's going to rent it for $1,000 a month. And now Sean sends her a certified letter saying, I'll pay you 150. That's different, right? Her intent, in fact, she was getting ready to sign a listing agreement as a rental, or maybe she did sign a listing agreement as a rental, or maybe there's even a for rent sign on the front of the building. But if she now gets an unsolicited letter, and I've had clients in this position, that's different. It really is a matter of state of mind at the time you purchase the property. And I suppose, depending on how many transactions you participate in over the course of any 1 year, you could potentially make the case that, look, I bought it for 100. I put 10,000 into it. I figured at that point it was worth 110, maybe 120, but I found out it was really worth 150. And somebody was willing to pay me 150. The world changed around me. I have to take that offer.
So can I give you a real life scenario to kind of explain
Sure.
what I'm saying? So
Sure.
I have a multi-unit that I was rehabbing. And once I got towards the end, I had it on the MLS to actually rent it out. I was doing the appraisal to refinance out. I was using hard money. When the appraisal came in, it came in about 175 more than we expected. So right off the back, I have a whole lot of equity. So although I have it on the MLS to rent, I said, well, let me put it up for sale as well, and let's just see what hits we get. And of course, we get some great numbers. So at that point, I decided to go ahead and sell it. Now, I can show that I had it for rent on the MLS. That was my original intent. But because the appraisal came back a lot higher than I expected, I figured I would take those funds and roll into something else. So I decided to sell it. So would that qualify me to say, well, my original intent was to rent it, but I didn't.
Sean, I like those facts. And with any 1031 exchange, I would want to bring, especially facts like these, I would want to bring your accountant into the conversation.
Right.
Look, in my mind, we purchased this property for X. We put a couple of dollars into it. We thought it was going to be worth Y. And we have it listed on the MLS. The individual units are listed on the MLS for rent. And we can document what date we put the property in the MLS for those units to be rentals, right?
Yep.
And then we say, well, you know what? We need to get it refinanced because we started this project with hard money. So we go and we get an appraisal as part of the refinancing process. And that number comes back as much greater than what we anticipated. So you know what? I think I'm going to continue to try to rent it, but let's see if maybe somebody wants to buy it. And then we get a number that's just way too good to be true. And we can document that we had planned to do it as a rental, but the market was much hotter than we anticipated. The value was much higher than we anticipated. So we entertained offers to sell it. In my humble opinion, I think that would probably pass muster with the IRS. However, ultimately, at the end of the day, I tell every taxpayer with questions like this to run it past their CPA because they're helping you prepare your tax return and they're signing that paper also.
Gotcha. Okay.
David,
And some might, just 1 second, Susan, and some might suggest, you know what, every once in a while, it's better to just pay the piper for whatever reason they have in the back of their head. So there's that.
Okay.
So,
Thanks.
my pleasure.
I was going to say, if I remember correctly from one of your previous classes, I think you talked about these are guidelines from the IRS, not fast rules, like the guideline generally to rent it out for a year. And that under that, you know, we're in a gray area. All these scenarios that are being discussed, like you said before, depends on the CPA and their willingness to take a risk with the IRS. And thank you for pointing out, as real estate professionals, we might be under more scrutiny in that gray area. Would you say the safety zone is having a rental history of at least a year?
So,
My question was actually the opposite. Sorry to chime in.
no, please.
The question was more, especially with COVID, if the intention was to flip the home. I'm trying to recapture 1031 money. I did a 1031. I bought another property. The intention was to renovate in less than a year, get back my basis from the previous from the property, and then move into something else. So if the flip takes longer than a year for whatever reasons, 3 months of no construction being allowed, contractors getting COVID, do I now have to do another 1031? And can I still get my basis out?
Well, first of all, pulling out your basis, pulling out your initial investment itself creates a taxable event. And we're going to talk about some of the additional rules in a moment. Most of what we're talking about here today is in fact black and white hard answers from the IRS. It's coming right out of the regulations. Whether you should rent a property for 1 year, 2 years, 5 years is a gray area. Every once in a while, somebody in Congress proposes that we should insert a 2-year holding period onto investment properties. And as an industry, we lobby against that because we know there are times when 2 years isn't right for whatever reason, right? Let's say you're married and your spouse is in the military and gets transferred to San Diego. Well, you don't want to have investment properties in Philadelphia if you're moving to San Diego. So the property you bought 6 months ago is now going to become a sale property instead of a rental. And I could come up with scenarios like that all afternoon. None of us has time for them all, but so Nicole's initial thought was she was going to buy it and fix it and flip it. But between COVID and permitting and a variety of other factors, it took her much longer to get the process completed. Does that now put her in a place where she could do a 1031 exchange where she might not have been able to do so previously? I don't know, Nicole. And here's the general rule that I give to my clients when we're talking about, does this property qualify? If I look at the tax return that you file for calendar 2020, are you reflecting the ownership of that property as an investment property? Did you attach a Schedule E showing that you bought it for this and you were attempting to rent it, those kinds of things? This conversation usually comes up in the context of, a Jersey Shore property, right? Or a Poconos property. Yes, we go there every weekend. My wife and the kids go there from Memorial Day to Labor Day. I work Monday to Thursday, and Thursday afternoon I work a short day and I jump in the car and I drive down and we spend the whole weekend together. And I wake up early on Monday morning and come back and work in the office all week. And I just repeat that all summer. And, but we bought that property because it's on the beach block on Ocean City or Wildwood or Longport or wherever it is. And it's going to be a great investment. Well, but it may be a good financial investment long-term rather than renting each summer. But if you didn't treat it as an investment property on your income tax return, then you're certainly not likely, you're probably not well advised to treat it as an investment property for 1031 exchange purposes. Okay. Folks, one of the things I didn't say at the beginning is you guys now all have an unconditional license to reach out to me and ask further questions beyond today's program. And even the people who watch this on a video afterwards, my contact information is on the last slide. Susie has my contact information. She knows how to reach me. She's got my personal email, my personal cell phone. About the only thing she doesn't have is my social security number. So please, so let's move forward a little bit. If we're going to boil 1031 exchange down to one slide, this would be the slide. Okay. And this is all talking about if we want to do, if we want complete deferral to the extent permitted. We're going to receive nothing other than like-kind property. So I'm going to sell real estate. I'm going to buy real estate. It's not going to include a boat or a car or any other equipment like that. I'm going to comply with the 45 and the 180-day timeframes, and I promised we would talk about what identification means. That's, I'm pretty sure, the next slide. We're going to trade equal or up in total fair market value. So you're going to hear a lot of people talk about the math of a 1031 exchange. If we buy for equal or greater than what we sold, and we roll all of the cash that we generated at the sale, then we have a 1031 exchange, at least on math, that works. We can replace that. So the next bullet point talks about having equal or greater debt, but I can replace debt with cash. And I've seen people buy their replacement properties all cash for a variety of reasons. And you don't want to have at any point in time constructive receipt of the cash proceeds. They must go directly to the qualified intermediary. So I received a phone call earlier today from a client who has one 1031 exchange teed up for Friday, but the client said, oh, wait a minute, we just sold another property last Friday. Can I include that in my 1031 exchange? Well, that was last Friday. I can't fix last week. And they still have the check in their hand that they haven't cashed. They want to know if that's okay. No, the closing took place last week. We have to have everything in place. The check is payable directly to the taxpayer. That's not going to work. So let's talk about what identification means and the restrictions on the numbers. Generally speaking, the identification must be in writing. It must be signed by the taxpayer. It must clearly and unambiguously define what the property is. So you can't simply say, I'm buying a townhouse in South Philly. That's about as vague as it gets, right? You also can't say, I'm buying a unit in the Marina condominium. Well, unless there's only one unit in the Marina condominium, that's pretty vague also. You need to tell me which unit. The Marina condominium itself is probably a valid descriptor. So I could say, unit 1B, the Marina condominium in Philadelphia. That would probably be sufficient because theoretically, anybody in that neighborhood would know where the Marina condominium is. In fact, the regulations give the example of the Mayfair apartment building. Theoretically, everybody in town knows where the Mayfair apartment building is. Generally speaking, most descriptions are the street address. Sometimes it's a legal description, but it's generally a street address is perfectly fine. So how many properties can we identify? And this is the question that comes up a lot. Folks, these are three rules. They operate independently of one another. You start at the top of the page. If you satisfy the first rule, you can ignore the next two. If you fail the first rule, you move on and so forth. So the first rule is identify up to 3 properties. It does not matter what their values are. Again, you want to trade equal or up if at all possible. Any money you pull out of the transaction. So if I sold for 100 and I only buy for 90, that 10 is exposed to taxation. We can identify up to 3 properties, and they can be listed as I'm either going to buy 123 Main Street or 27 Oak Street or 22 Market Street, whatever their addresses are. I intend to buy one of the following 3 properties. I intend to buy 2 of the following 3 properties. But what happens if you want to identify more than 3 properties for whatever reason? Usually that comes up when somebody's looking to diversify. They've got a big property, they have all of their eggs in one basket, and they want to start buying smaller properties so that they can spread the wealth around maybe to different neighborhoods, maybe to different counties, maybe even to different states. Well, if I identify more than 3 properties, then the total value of all of those properties that I identify must not exceed 200% of what I sold. So I sold $100,000. I'm identifying 4 properties. Those 4 properties should not exceed $200,000. Simple math. Okay. But what if I violate that second rule also? I've identified more than 3 properties. I've identified, and they equal more than double the value of what I sold. Here's the example I use. I sell one property for $100,000. I identify 10 properties that aggregate to $1 million. 10 is clearly more than 3. 1 million is clearly more than 100,000. Under that third rule, I need to acquire 95% of the value that I've identified, meaning I need to close on $950,000. If I do not, then my exchange will fail. So I'm very careful when I look at the identifications that our clients submit to us. If they've identified more than 3 properties and they've gone over that 200% number, I pick up the phone. I will tell you that 98% of our identifications use the 3 property rule. 99% of what's left use the 200% rule. And almost 100%, in fact, in recent memory, 100% of the people who use that 95% exception are buying everything on their list. So we had a guy selling he owned a 50% interest in a building down in Virginia. He bought a dozen condos and townhouses, all within walking distance of either Harvard or MIT up in Boston. And it was well more than double the value of what he sold. Well, he identified 12. He intended to buy all 12. And he's fine with that. He met the 95% threshold. He bought at least 95% of what he identified in value. Okay? So that's what we've talked about so far, is the traditional forward exchange, where we sell our first property, buy our second property in that order. And what happens again is we sell the property, cash goes to the intermediary, we identify our new property, cash comes from the intermediary to buy that property, 1031 exchange is done. But what happens if we need to buy that new property first for whatever reason? We buy first and sell last. That's called a reverse exchange. So why might I want to do a reverse exchange? Well, sometimes it's simply a matter of poor planning, right? The client overpriced his relinquished property, got himself into a bind. His contract on his replacement property is hard, can't get an extension. He has to buy the replacement property. Frequently, however, it's the result of seizing an opportunity or something strategic. Maybe Sean and I are out having a drink one afternoon, and he says, I'm thinking of selling that property I have over there around the corner, and I'm just not sure. And I say, Sean, what are you thinking of asking for it? He said, well, if I get the right buyer, I'd sell it for $5. I say, Sean, if I give you $490 in 10 days, will you take it? He says, yeah. Now, I know in the back of my head, if he puts it on the market at $5, in today's market, there's going to be a bidding war, and it's going to go $5, $5.10, $5.20, $5.30. But I just offered him $490 cash, no contingencies in 10 days. He looks at $490 cash, no contingencies, 10 days as well worth avoiding the headache of screening all of those other buyers. And I just bought a property. And if I had been in that bidding war, I might have had to pay $550 or more. So this was now a strategic opportunity. The other strategic way to look at this is, maybe I did buy the property. Maybe I did find a property that was already exposed to the market. I did get a good opportunity. And I have one property around the corner that is fully occupied. It's cash flowing positive. It's doing well for me. Now this one comes along, and it's also fully occupied. The tenants are all paying their rent on time. It's in decent shape. And if I buy this one before I sell that one, for up to 180 days, I'm going to have double cash flow. Is there anybody here who would say no to double cash flow? I didn't think so. So a reverse 1031 exchange looks an awful lot like a forward 1031 exchange. The difference is that during that 180-day exchange period, I actually own both properties. Now, the IRS says that from a technical standpoint, you cannot own both properties at the same time. and call it a 1031 exchange. So they created this notion, this fictitious entity called an exchange accommodation title holder. And what happens is when you're ready to buy that replacement property, we go out and we form an LLC. So I'm going to call it New Property LLC. And our company is the sole member of New Property LLC. Using your money, we purchase that property for you. If you have a lender involved, you and I will talk to the lender and make sure that they're on board and everything is going to be fine. And we will close on that property in New Property LLC. We will lease that property to you for $1. It'll be a triple net lease. You will be allowed to manage that property as if it were your own. You'll collect the rents. You'll take care of all of the maintenance. And it will be your property, except that on title, I own it for you. You'll continue marketing your relinquished property. And when you go to sale, when you go to closing on that relinquished property, you must do so within 180 days, just like any other 1031 exchange. And when you get that cash from the sale, that cash will flow through me. You loaned me the money to buy that new property for you. So now I will repay that loan using the cash that we just generated from the sale of your relinquished property. And at the same time, I will give you back your deed. Actually, I will give you your LLC. Again, in Pennsylvania, whether I give you the deed or the title or the LLC, there's going to be another transfer tax. So Pennsylvania doesn't like 1031 exchanges. No way, no how. They just don't. But if you do a reverse exchange outside of Pennsylvania, in I think 47 of the other 49 states, there is no double transfer tax for transferring that LLC over to you upon completion of your reverse exchange. Okay. One of the other downsides, one of the big downsides to a reverse exchange, however, is that the fees go up. I told you that a traditional forward exchange where we sell first and buy second, depending on complexity, is going to cost between $1,000 and $2,000. A reverse exchange is going to start at about $4,000. But if you're owning double cash flow, if you're getting double cash flow for 6 months, it really only takes a couple of weeks to cover that extra cost. Okay. Now let's take the concept of reverse exchange and take it one further. What if I buy a property and I need to make improvements to it? Now my pictures here are rather extreme because I show myself selling an apartment building, buying raw land and building a whole new building inside of 180 days. Can't happen. I don't know who you know. I mean, literally, unless you're doing it for some reality show, you're not getting it done in 180 days. But maybe I'm selling that apartment building on the left-hand side and I'm buying a different one. So I sell the first one for $500,000. I buy the second one for $450,000, and I'm going to go through and I'm going to rehab the 4 kitchens and the 8 bathrooms in those 4 units. Well, I can do that in 180 days. I can rehab 4 kitchens and 8 bathrooms in 180 days. Heck, I can do that even if I'm doing the work myself. The permitting process on that is easy in most places. I can buy stock cabinets from Home Depot or Lowe's or any other cabinet shop. That's not a big deal. The mechanics are very much like the reverse exchange. We're going to sell your relinquished property. The cash will come to the qualified intermediary. We will buy that new property for you in New Property LLC. You will be the construction manager. You'll tell me how often to pay the contractors. I'll send wires to those contractors. Typically once a month is the way most of them work. And when all of that construction is complete, we'll give you back your LLC and your property. No. Okay. So there's another variation. But what about a situation where maybe I own a 4-unit property and I live in one of the 4 units? Or I live in a triplex, I live on the 3rd floor, rent out the 1st floor for retail, rent out the 2nd floor for other residents. Or the bottom one, I live in that house on the left-hand side of the picture. At the right-hand side of the picture is an operating farm, and I own all of it. These are what we call a mixed-use property, right? So let's use the triplex as an easy example. I live on the 3rd floor. I rent out the 1st and 2nd floors. The 3rd floor, because it is my primary residence, does not qualify for Section 1031. It does qualify for the 121 exclusion. So that's great. The 2nd and 1st floors will be my 1031 exchange. And how we divvy up the sale proceeds will be determined by how my accountant has been treating this property on my income tax returns. Most of the time, in my experience, my accountant was lazy and it was 2/3 rental property, 1/3 my residence. Some accountants will say, well, no, wait a minute. That 1st floor unit is a retail space with storefront. That's more. So maybe instead of 1/3, 1/3, 1/3, maybe it's a total of 70% for the 2 units downstairs and 30% for my house, my apartment. And that's fine too. However, the accountant has been treating that building is how we're going to treat it for 1031 exchange purposes. Truth be told, the majority of the time when we have transactions like this, it's a duplex or it's a simple fourplex, and there's very little delineation between the units. Maybe the owner's unit has access to the basement and the other units don't, or the owner's unit has access to the rooftop and the other units don't, in which case the numbers skew a little bit. But in my experience, the majority of these transactions are simply divided by the number of units in the building. The other thing that we can keep in mind is what we call less than fee interests in real estate. We all know that if I sell my property outright to you, I'm selling you a fee simple interest in the property. You get the whole bundle. But I can sell timber rights, mineral rights, air rights, transferable development rights. Maybe Nicole and Sean and I each own a property together as tenants in common, 1/3 each. And I decide I'm moving to San Diego. So I offer to the 2 of them, which one of you wants to buy my 1/3 interest? I can do that also. I can sell my 1/3 interest to Nicole, and I can go buy another property elsewhere. Similarly, I can sell my entire property to Sean, and now maybe Nicole and I go out and buy something together, 50-50 or 60-40 or whatever it is. That's fine also. We're coming up on near the top of the hour, and I assure you, I will stay until you guys are done asking questions. But I just have one more slide I want to go through real quick. And the idea of vacation homes comes up in questions a lot. Vacation homes generally will not qualify. If the vacation home is one where I used it exclusively and I never rented it out, then for sure it is not going to qualify. But what if I have a Jersey Shore home and I do try to rent it out? I have it listed with, you know, Beta Ocean Realty or whoever it may be. And, you know, there's a week that it's not rented. So I go down there that week. And then there's another week that it's not rented, and I go down there that week. Well, then that one will probably qualify because its primary use was a rental. But if its primary use was my property, then no. Now, I can convert it from primarily my property into a rental by moving it out and moving my stuff out and then renting it out for a couple of years. But generally speaking, a vacation home or a second home is not going to qualify for a 1031 exchange, and certainly not if you used it exclusively over the last couple of years. We talked about the third bullet point, the one in the middle. Clients periodically will ask, well, can I pull $10,000 out of a transaction? Yeah, right? Everything that we've talked about, if you follow the regulations, if you follow the blueprint that this presentation provides, then you will have deferred 100% of the eligible taxes. Again, Pennsylvania doesn't recognize Section 1031. But if you follow this blueprint, you'll otherwise have deferred all of your taxes. If your client wants to pull $10,000 out, that's fine. That $10,000 is subject to tax, right? It's not going to completely poison the entire exchange. It's just that $10,000. Okay? Or 50,000 or whatever the number may be.
Can you define boot? Because I've had it represented to me by a 1031 intermediary as something very different than what you're referring to here.
Okay. So boot, very simply defined, is anything that you receive that is not like kind to what you sold. So here we're selling real estate. Boot can be debt relief. Boot can be cash that you receive. Boot can be any other property that you receive as part of the transaction. But essentially, it's anything that you receive that is not like kind, well, not essentially.
So if I had a mortgage on a property and I sell it, pay off the mortgage, and buy another property and do a 1031, is that mortgage that I paid off boot? It was never my money. Do I have to pay capital gains on that mortgage?
Okay.
Because the property I bought was less value than the one I sold. And I had it had a mortgage on it.
Sure. Well, so right off the bat, Nicole, if we buy a property for less than what we sold, we're going to have a boot problem.
Let me be more clear. It was a reverse 1031 with improvements. So the construction, the purchase of the land and the building that was built, yes, reached that point. But the intermediary told me I would have boot, and I did not understand why I would need to pay capital gains on the mortgage that I paid off.
So if structured properly, we can buy the new property. I sell my old property. Was it a reverse improvement or a forward improvement? Forward improvement. Okay. So I sell my old property. I'm going to put my numbers on this transaction. I sell my old property for $500,000. Okay. I pay off a mortgage to TD Bank for $150,000. Okay. Now I have $350,000 that's going to go to my intermediary. So far, so good. I now use most of that $350,000 to buy a new building. But I need to make improvements on it. I want to get up to $500,000. To get up to that $500,000, I can either spend my own cash, if I so choose, or I can get additional financing from a lender, okay, or a combination. I can replace debt with cash, but I can't replace cash with debt. So in that example, I can't invest $100,000 of my money knowing that the lender will give me 80% loan to value because I have spectacular credit, right? Because that now leaves me with cash left in my pocket. Cash left at the intermediary at the end of day 180 is absolutely going to be taxable no matter what you do. Okay? And Nicole's question here to me raises a very important point that I want to make to you folks. Even if your client has already chosen another intermediary, I want you to feel comfortable calling me to ask questions. Because one of the things I've noticed over the years, look, I've been doing this for 20 years full time. I'm a licensed attorney. I was practicing law before that for more than a decade. I've been doing this for more than 20 years now. I'm getting old. But one of the things I know is that most intermediaries don't explain this well, right? It's one thing to know it. It's another thing to be able to explain it. And as a past board member of our National Trade Association, look, we have a very small trade association, by the way. The Federation of Exchange Accommodators' largest ever annual conference only brought 250 paid attendees. So the Philadelphia Board of Realtors has more than that show up for a coffee meeting when there's no pandemic. We're a small association. And I will tell you, of the 250 people who show up in any given year, lately it's been closer to 150, there are only about 8 or 10 of us who ever speak. Actually, there are about 20 of us who ever speak. In any one year, it's between 8 and 10 or 12 people who speak. Most of the rest of the folks are very content to sit in the back of the room and listen. Why? Because they can't explain it. So if your client's already chosen another intermediary, I won't be offended if you call me up and say, David, I'm sorry, my client has already picked ABC 1031 in Umpqua, I forget where, in Ottumwa, Iowa, right? It's owned by Radar O'Reilly. He's a really nice guy, but we all know he's a whack job. That's cool. Your client can use Radar O'Reilly 1031 in Ottumwa, Iowa. I'm cool with that. I want you to understand what's going on. And maybe next time you'll convince your client to use me instead of Radar O'Reilly. So that's all of the slides that I wanted to go through. I do want to invite you to ask more questions, and I will stay until the last of your questions is answered.
David, did I miss the end to Nicole's question? Are you paying taxes on the money that is being used to pay off the mortgage?
The money, so I didn't clearly answer that question, and thank you for holding my feet to the fire.
No problem.
When I sell my property for $500,000 and I pay off the $150,000 note to TD, at that moment, it is not yet taxable. Okay. If I only buy a property for $350,000, then I've traded down. So I've created a taxable event anyway, whether it was mortgage that I didn't reinvest or cash that I have left in my pocket. Okay. Other questions?
So I don't know, I might have missed it. I asked a question in the chat. If I have a property that's, say, under my name, I sell it and I want a 1031 exchange to another property I purchase, can I put the new property on an LLC at that point without any issues?
Yep. So here's the answer to that question. Generally speaking, the answer is yes. If I own the property individually in my own name, not with my wife, not with anybody else, just me, and I then go buy the next property in an LLC of which I am the sole member, just me, nobody else, then that LLC for federal income tax purposes is disregarded, and everything that LLC owns shows up on my tax return. So yes, that works. But as soon as that LLC has 2 or more people, it's a completely new taxpayer and it doesn't work.
Now, what if down the road, let's say 2 years later, you add another person to that LLC? Does that change it later on down the road?
Well, once it becomes a multi-member LLC, it becomes its own taxpayer and it will have to file its own tax return. So now you will have transferred it. Just the very act of adding that second person to the LLC, right? The Daniel LLC is owned 100% by Daniel. And now Megan becomes a member of that LLC. You've transferred that property from your own individual ownership to a whole new taxpayer. You've just created a taxable event. Now, if you want to invest with Megan, maybe you sell to her a 50% interest in the property instead of a 50% interest in the LLC. And she buys that 50% in the Megan LLC. So now the property is owned 50% by the Daniel LLC, 50% by the Megan LLC, and you will do a 1031 exchange to the extent that you just sold a 50% interest in that property.
Thank you so much. And I just need your email here. Is that going to be sent out, Susan?
Yeah, I'll send out everything with a link to his business page as well as his personal email and his work email.
Yeah, look, my personal email is yours. My cell phone is yours to use. My office number is right there. Contact me however you wish. If I don't get back to you in 24 hours, try again. If I don't get back to you in 48 hours, call the hospitals. Other
Until
questions?
we get kicked off, and the one question, it says, Jeff is asking, if I sell a property in PA and buy as a like property in another state, which state would assess the state tax?
The state level taxes are assessed at the time of the sale. So when you sell your Pennsylvania property, you will recognize the Pennsylvania state taxes. Okay, if you're also a Pennsylvania taxpayer, those taxes are going to come home to bite you even when you sell your next property, because it's still showing up on your Pennsylvania income tax return. So when I have clients who do not otherwise have any connection to Pennsylvania, telling me that they're looking at properties in Pennsylvania, I strongly encourage them to consult with their accountants, because they will have now, put themselves in a position where Pennsylvania rules apply to at least part of the transaction, or future transactions.
Sorry to hog the line, but and bog everybody down with my specific questions. But if I sell a place, let's say it's a $900,000 property, and there's whatever $450,000 mortgage on it. I take the proceeds from the 900, pay off the 450. With the remaining 450, I buy 3 smaller, whatever, South Philly row home investment properties with the remaining cash. I know you mentioned, I think it was called boot. I just don't have a clear understanding. So when you pay off the debt, you said it's not a taxable event, right?
Correct. But on your example, simply paying off the debt to TD or Wells Fargo or whomever, simply paying off the mortgage itself is not a taxable event. However, on your example, we're selling for 900 and we're only replacing with 450. So that 450 that we did not reinvest is going to be taxable. And in your situation, in the example you just gave, it's called mortgage boot because we had $450,000 in debt that we no longer have. And to compound matters, the IRS is going to say that you owe tax on that 450, but you don't have the cash to pay the tax on the 450 because that was all debt.
Thank you. I'll reach out offline with more specifics.
Please, feel free.
David, we have a question. Are there any CPAs you could recommend of expertise on 1031 exchanges?
I work with several CPAs around the area, and whoever is asking that question can shoot me an email. I want to get a little bit of personal information from that person, then I'll make some recommendations.
Okay, perfect. Thank you. Any other questions? I don't know when we'll get kicked off. I'm here to hang with everybody as long as we want. Now's a good time to throw out the questions. I know one question that came up. I know there was some talk about, the difference between an IRA and a 1031. I just to make sure that whoever asked that, you feel comfortable with the answers. I know we discussed that some.
I have a question.
Sure.
Okay, so I think I mentioned in the beginning that I'm selling off a few properties, and I want to kind of roll those over into larger investments. So I'm doing some constructive financing now, where I'm actually looking to acquire some apartment buildings, about 22 units. So in this case, I'm doing it where I'm not buying outright to kind of get past the transfer tax and things like that. I'm buying the whole LLC. I'm not sure if you're familiar with the process, but in that sense, could I use funds from the 1031 exchange to purchase in that sense? Because by buying the LLC, I'm getting it at a much lower cost, usually just whatever the refinance cost of the mortgage is to kind of pay off the current owner and remove them from the LLC. Can I use the 1031 funds in that way to purchase the apartment buildings and continue to kind of rinse, repeat doing that up until the funds are depleted?
So a couple of things. There are more questions in there than I think you realize. One of the questions is, can I sell multiple properties to buy one property? And you can do that just like we could sell one property to buy multiple properties. We could also sell multiple properties to buy multiple properties all inside of one 1031 exchange if we can get the timing to work.
Okay.
But your specific question was, can I sell one investment property and buy an LLC as my replacement property? And the answer is yes, but. The but is that the LLC must be a single member LLC, and it must have as its only asset real estate.
Okay, and that's the case. These are all, like, each apartment building is actually held in an LLC individually by themselves. Now, I will have to confirm that, you know, it's a single member LLC. I didn't ask that question, so that's something that I'll have to find out about. But in that case, it will qualify if I'm just using the funds to just cover whatever the refinance cost would be if it's a single member LLC.
Yeah, and the reason it needs to be a single, yes, the answer is yes. And the reason it needs to be a single member LLC is that if there's multiple members, it's taxed as a partnership. And if you're coming in as an individual, one person can't be a partnership. So you've destroyed the LLC in the process, or you've destroyed the tax structure of the existing entity.
Makes sense.
Okay, speaking of LLCs, David, there was another question a little bit different. If you have a two-party LLC, say Sean and I have an LLC, and we're selling the property in our LLC and buying another in the same two-party LLC, then would a 1031 be able to apply?
Yeah, if we have two people inside of one LLC, so we have the Susie and Sean LLC selling one property, and the Susie and Sean LLC is going to go ahead and do a new 1031 exchange to buy a new property, that's fine. What we have to be careful of is if Susie or Sean want to go, or if Susie and Sean want to go in separate directions, what do we do next? Because that's a multi-member LLC, that's not either one of them on their tax returns, it's a whole new taxpayer altogether. So that would be something there where, and this conversation comes up kind of regularly, if Susie and Sean own a property together in one LLC, and they're thinking maybe we want to sell it next year, then it would be advisable to talk to your accountant now about dissolving the LLC now in advance of listing the property for sale. Hold it as the two of you as individuals, as tenants in common for a period of time, and then sell it.
I just wanted to throw out there too, as a salesperson in real estate, what I love about knowing at least even just a little bit about this 1031 exchange strategy is you have the potential, if someone's selling a property and it fits for them, you could turn one sale into four, right? They're selling the property and then all of a sudden you're the agent helping them sell, but then you're helping them buy up to maybe even more given his different scenarios.
I'm submitting a proposal to teach at Triple Play this year. So if you guys make it down to Atlantic City, one of the topics in my outline is how to use Section 1031 to uncover hidden listings and generate additional transactions. And maybe you guys want to, we'll come back another time and do that as a separate webinar. We can do that too. But that's going to be in my outline for Triple Play in December. In fact, I'll give you one very important nugget right now out of that seminar. I'm assuming that each of you has a friend who is a title agent or a title agent with whom you work quite regularly. If you partner up with that person and get a list, and a short list, start with a short list, a list of properties where the tax bill goes someplace else. If the tax bill is going someplace else, it's a pretty safe bet that that's a business or investment property. And you can reach out to that person and say, hey, if you're interested in selling, I can help you with a 1031 exchange and you can avoid the taxes. You'll write something a little more articulate than that, but that's the basic gist of what you would say. And that's a property that's not currently on the market. And one of the previous questions about identification was, does the property have to be on the market? The answer is no. Do you have to enter into a contract during the 45 days? The answer is no. You simply need to make sure that you'll be able to buy, because if it's not on the list and on day 45, you can't buy it on day 180.
All right, so that is fantastic. Any other questions or, I know we're a little bit over time and appreciate everybody hanging in there.
I appreciate you guys for being here as well, very much.
I will post the slides in the Facebook groups, and also feel free to email me directly if you want, and I'll repost his contact information as well. Thanks, everybody, and have a great day.
Thanks all.
Okay,
Thanks.
thanks. Take care.